This is Nightly Business Report with Bill Griffith and Sue Herrera.
Losing momentum. There are new signs global growth is cooling, and that could ripple through the U.S. economy and your investments.
Bankruptcy filing. California's largest power company is now expected to seek Chapter 11 protection amid mounting costs related to the state's massive wildfires.
Expansion plans. Two major automakers are increasing production at a time when the industry is in transition. Those stories and more tonight on Nightly Business Report for Monday, January 14th.
And we do bid you a good evening, everybody, and welcome. This wasn't exactly how nervous investors wanted to start this week. A new report out of China showed the sharpest decline in that country's exports in 2 years, compounding concerns about slowing global growth. And then you add to that a report from the Organization for Economic Cooperation and Development that also pointed to a further slowdown in the global economy this year. And you had a pretty cautious Monday as a result on Wall Street. The Dow fell by 86 points, closed at 23,909. The Nasdaq was down by 65. The S&P slid by 13. Eunice Yoon starts us off tonight from Beijing.
China's latest trade data reaffirms that the economy here continues to decline. December export as well as import figures missed expectations. Exports dropped 4.4% from a year ago. Analysts had expected it to fall to a 3% rise. Imports shed 7.6% versus a forecast of 5% growth. China's trade surplus jumped to $57 billion. Exports to the U.S. in particular slid 3.5%, and the surplus with the U.S. for the year was the highest on record going back to 2006. A few important points from the data. The tariffs are hurting exporters. Companies front-loaded orders, which probably will taper off. Demand globally is softening. Shipments to the U.S. were the only ones affected. Exports to Europe and Japan also fell. Domestic demand is struggling more than expected, despite efforts by the authorities to stimulate growth. Expectations are that Beijing will have to speed up its policy easing and other measures to boost the economy, and that President Trump could use the record trade surplus to pressure Beijing as part of the trade negotiations. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Adding to those global concerns is a key vote tomorrow in the United Kingdom. It is a vote that could help determine that country's economic and political future. Willem Marx is in London tonight.
Theresa May and some of her most senior ministers have spent the last 48 hours trying to drum up support among sceptical lawmakers in their own Conservative Party ahead of a decisive vote on the Prime Minister's Brexit proposals. She's warned those of her own MPs who say her plan could leave the UK tied too closely to Europe that if they don't back her version of Brexit, then they could end up with no Brexit at all. That's if a second referendum is called that reverses the 2016 one. Prime Minister May had last month faced this same defeat and postponed that previous attempt to push this plan through the House of Commons. Little's really changed since then, though as a consequence there's now just over 10 weeks left until the UK is scheduled to exit the European Union with or without a deal.
I say we should deliver for the British people and get on with building a brighter future for our country by backing this deal tomorrow.
Government economists and the Bank of England have warned that a no-deal departure would economically disastrous for Britain. But nevertheless, all indications are that May will still lose tomorrow night's vote. She'd then have until next Monday to come back with a new Plan B. Before then, the opposition Labour Party could push for a motion of no confidence in the government that could, in turn, trigger a fresh national election.
The government is in disarray. It's clear if the Prime Minister's deal is rejected tomorrow, it's time for a general election. It's time for a new government.
Uncertainty remains the watchword here in Westminster, and it means investors, lawmakers, and ordinary British voters still have more questions than they have answers about the UK's immediate political future. For Nightly Business Report, I'm Willem Marx in London.
So how will all of these growth concerns around the globe impact the market and your investments? We're joined now by Jeff Kleintop, Global Chief Investment Strategist over at Charles Schwab. Jeff, welcome back. Good to see you again.
Thanks for having me.
You've been worried about the global outlook for some time now, and I would assume that this latest wrinkle with Brexit only adds to those concerns.
The global economy has been expected to slow, Sue, whether it was by the OECD or the World Bank or the IMF or most pundits. I think we're looking for slower global growth this year. But the data we've seen come in the last month has been even slower than that. And that's raised a number of concerns. It seems to be tied to these macro issues. You mentioned Brexit. There's also the protests in France that have derailed the plans there. There's concerns about the Italian budget that have subsided for the time being, but still had an impact on economic growth. And then, of course, there's the U.S.-China trade dispute, which still lingers on. All those factors seem to be weighing on global economic output.
And certainly it weighed on our stock market in the fourth quarter, as apparently Wall Street was anticipating a slowdown of some kind here. Where do you think we will see that slowdown start here in the U.S., Jeff?
Yeah, that's interesting. Already we've seen it affect earnings growth. Earnings expectations have pulled back pretty sharply for 2019 for U.S. companies, given their global exposure. Where does the growth slow? It's hard to say. I think clearly we're seeing some impact on U.S. companies. How that impacts U.S. consumers and businesses in terms of their economic output, we'll have to see. Certainly some slowing is likely. I think what's more interesting is the fact that the market seemed to already price in a recession as of the end of the fourth quarter, given that very sharp pullback. The way I look at the markets, the way I look at the economic data, it looked like it had already gotten ahead of itself and priced in that recession, which may yet be coming. But we're not there yet. I wouldn't be surprised to see a little bounce in the market here in Q1, but that doesn't mean the coast is clear.
All right, if that's the case, what are you advising investors to do, especially those with a longer-term time horizon?
A longer-term time horizon's key right here. And remember, this is why we own bonds in our portfolios, to buffer from some of the equity and the volatility markets. But if indeed a Q1 rally gives way to weakness later in the year, then you want to consider sectors like healthcare. Those earnings may be less vulnerable to a pullback in global economic conditions and other more defensive areas of the stock market. And remember, broad diversification may pay off here in a way we haven't seen in some time. Correlations have come down, meaning markets are behaving a little bit more independently from each other than they have in a while, and that offers some benefit to diversified investors.
Jeff, thank you as always. Jeff Kleintop with Charles Schwab.
Thank you.
Elsewhere, investors are also nervous about earnings, which we will start to see a lot of this week. Citigroup got things started this morning with a mixed report. The bank posted better than expected profits, thanks in part to cost cuts, but its fixed income revenue fell about 20%. But that didn't stop investors from buying the stock today. It sent the stock nearly 4% higher in today's session.
And now to Washington and the partial government shutdown, which is now the longest in history. Negotiations between President Trump and congressional Democrats appear frozen. It's not just the furloughed federal workers who are feeling the financial strain, but also, as we've been reporting, businesses as well. And that's also true for commerce at the shipping ports, airports, and on the road. Contessa Brewer is in New Haven, Connecticut.
On land, in the air, and at sea, worries are growing over the federal government's shutdown and the potential for serious problems.
Clearly, some of the questions have been posed to me by some of our customers, our shippers, retail associations. There is a concern with regard to the impacts of a shutdown.
At the nation's second busiest port in Long Beach, California, federal employees for Customs and Border Protection and the Coast Guard are showing up, but they're not getting paid.
And we've learned some 300 ships are stuck at sea, unable to come into U.S. ports because of a technicality. You see, they're supposed to carry what's called a certificate of financial responsibility, essentially proof of insurance they can be responsible should something dire happen. And the Coast Guard has clearly listed on its website it's not processing those applications right now.
Global supply chain giant C.H. Robinson says the slowdowns aren't significant, but points out shippers aren't getting duty refund payments. Companies excluded from tariffs aren't seeing those exclusions recognized, so they're still paying and waiting for reimbursement. Without federal safety inspections, some ships can't refuel in harbor, costing them between 12 and 48 hours in delays.
Our industry runs very tightly logistically, and time is money, and you know, it may cost one owner X amount and may cost another owner X amount, and across the industry it's going to have an impact.
Domestic freight isn't seeing a slowdown because the Federal Motor Carrier Safety Administration is funded by the Highway Trust Fund, not the DOT budget. Federally chartered Amtrak remains up and running, funded through traveler revenue. But air passengers are seeing a slowdown at security checkpoints as TSA reports double the number of sick calls over the weekend, causing some closures in Miami and Houston. And air traffic controllers are suing President Trump over the shutdown. FAA safety inspectors are furloughed.
I'm out here because I wanted to raise public awareness and let the public know that there is no safety oversight, and let the public make their decisions as to whether or not they want to fly.
Even if the government opens tomorrow, there's a backlog. These agencies will need to play catch up, so the logjam won't disappear the moment the government shutdown ends. And right now, there's no end in sight. For Nightly Business Report, Contessa Brewer, New Haven, Connecticut.
Time to take a look now at some of today's upgrades and downgrades. We begin tonight with Delta, which was downgraded to neutral from buy at Bank of America Merrill Lynch. The analysts there cited the potential for slower demand, a decline in CEO confidence, and even the government shutdown. Price target $51. That stock fell more than 1.5% today to $47.75. Chevron was also downgraded to hold from buy at HSBC. The analyst cited the supply of crude and that stock's recent multi-year high. Price target $122, and that stock fell a fraction today to $111.72.
Still ahead, the future of Sears, from the man who literally wrote the book on that retailer.
Cold weather is heating up the natural gas market. Prices spiked again today on a cooler than expected forecast for the eastern half of the United States toward the end of this month. And that could potentially mean increased demand and tighter inventories. So prices rose by 15% in today's session.
California's largest utility plans to file for bankruptcy. PG&E faces billions of dollars in liability costs stemming from that state's deadly wildfires. That cut the stock price in half today. Aditi Roy takes a look at what this could mean for both consumers and investors.
A tumultuous 24 hours for PG&E as California's largest utility announced in a regulatory filing this morning that it plans to file for bankruptcy. That filing following the news late Sunday that CEO Geisha Williams is stepping down. Williams had been in the position since 2017. Since then, the utility has grappled with devastating wildfires, including the Camp Fire last fall, which killed at least 86 people, making it the state's deadliest fire in history. In today's filing, PG&E says if it were found liable for the costs of the Northern California wildfires the last 2 years, the liability would exceed $30 billion. That doesn't include punitive damages. The utility services 16 million customers in Northern and Central California. Experts say a bankruptcy would likely not disrupt service, but could increase rates. Some customers say they're unfazed by the prospect of rate hikes.
Not so much they filed for bankruptcy before.
While the utility did file for bankruptcy back in 2001 as a result of the energy crisis, some experts say a bankruptcy today would look very different from the classic Chapter 11 reorganization the utility went through more than a decade ago, since the wildfire risk will continue and perhaps even increase in the future. Insiders say stockholders of the utility would likely be wiped clean, and bondholders might have to fight for their claims in court. The utility could also be broken up. Experts say a bankruptcy judge could decide to separate PG&E's gas and electric businesses. And while all of these issues will likely take years to play out, some customers are already worried about how it will impact their pocketbooks.
It does concern me because with rent in Oakland, that's expensive enough. And for our PG&E to go up, that could cause some problems. I may have to get another source of income.
In addition to the civil liabilities, California's Attorney General and Butte County's District Attorney say they are considering filing criminal charges against the utility. PG&E says it plans to file for bankruptcy on or around January 29th. For Nightly Business Report, I'm Aditi Roy, San Francisco.
Newmont Mining goes digging for gold, and that's where we begin tonight's market focus with the company buying rival GoldCore for about $10 billion. It will create the world's largest gold producer. The deal follows Barrick Gold's agreement to buy Randgold last September. This latest consolidation wave in that industry is due in part to a dwindling supply of easy-to-find gold around the world. GoldCore rose 7% today to $10.38. Newmont mining dropped by 8% to $31.78. Elsewhere, Gannett has received a hostile takeover bid. The owner of USA Today got an unsolicited offer valued at $1.3 billion from MNG Enterprises. This is a hedge fund-backed media group known for buying up struggling local newspapers. And if this deal goes through, it would turn MNG into the largest owner of U.S. daily newspapers around the country. Gannett responded this morning by simply acknowledging it received the bid, and executives said they would consider it in due course. Shares of company surged by 21% today to $11.82.
Lululemon raised its profit and revenue forecast for the fourth quarter. The company has seen strong sales growth recently, and analysts expect that to continue both online and in China. Shares rose more than 5.5% to $139.73. Canadian cannabis company Canopy Growth said it received a hemp license from New York State, and it will establish U.S.-based commercial operations. The company plans to invest between $100 million and $150 million in its New York operations, and it will source exclusively from American farmers once it's up and running. The shares gained 11% to $42.49.
Earlier today, a bankruptcy auction was held behind closed doors in New York City, trying to decide once and for all the fate of iconic retailer Sears. Last week, remember, Chairman Edward Lampert, who is also the company's largest shareholder, made that revised offer of $5 billion. And today, a group of liquidators was scheduled to offer their own bids. The outcome of the auction will determine whether Sears and Kmart continue to operate or go out of business. Joining us tonight is Don Katz. He's the founder and CEO of Audible.com. Don is also the author of The Big Store, written back when Sears came through another crisis and became the #1 retailer around the country. The Big Store was recently reissued as an audiobook on Audible. I cannot tell you the number of people who have said that 100 years ago, Sears was the Amazon of its time. Amazon owns Audible right now, but the business models are very similar.
Well, they're similar in the sense of having engendered amazing consumer trust and also inventing consistently with great vision. It's different in the sense that we forget the 20th century was marked very much by consumerism being the mark of success for the rising middle class and just about everybody else. We really didn't come to that era of salary porn in the 80s and net worth porn in the last 30 years until fairly late. People marked their their sense of themselves by the fact that Sears was democratizing access to washing machines and sewing machines and dryers and then trash compactors and the like. And they earned and they created a sense of trust by figuring out ways to logistically and invention-wise get this to people. It was a genius company. It found the suburbs and named them in many ways. It did an amazing number of things. And at the beginning of the catalog days, it figured out how to sell something to someone that you couldn't see. So that alone, I deal in a two-dimensional
The parallel
world.
is online.
It's fascinating. I mean, but the idea of trusting farmers to pay their bills, credit, no money-back guarantees, ample free parking, you name it, they invented this. But they lost their way. Right. And I think now my book is still read in business schools and the like because it's a roadmap to how to create a truly inventive, great company, but it's also how not to have hubris and pride and myopia blindside you. It pretty much was over as a company a long time ago.
Where do you think it goes from here? Eddie Lampert still wants it in a very big way, continues to put in a higher bid. We don't know what way the decision is going to go, but what is Sears' way forward?
Well, I have stopped. I do other things with my day job now, so I don't. I have a feeling that Sears is over, except for basically being a real estate holder and an iconic brand that much older people spent their lives with. 1 in 30 Americans are working at Sears at the point I was writing this book. I basically think in many ways what happened more recently after I wrote my book is the financialization of the economy is somewhat mythic in the sense that great companies are built by unleashing things with capital. It's hard work and creativity plus capital. And this was just a case where it doesn't work that way. It's a bunch of real estate at this point.
But realistically and quickly, the model the retailer has to have today, if they're not just purely online, you got to have a brick and mortar store as well. There needs to be a good combination of
There's
that, right?
plenty of brick and mortar stores out there doing incredibly well. I mean, just talk about people in the hemp and cannabis world. I mean, look at the stores that are gearing up to be niche retailers. There's fantastic retailers out there, and Amazon actually has physical outlets that are really pretty genius too.
Right.
It's just that this idea of this mega corporation that at one point was the great American corporation of the 20th century, things ebb and fall.
Things have changed.
The name of the book is The Big Store. Don Katz, the founder and CEO, joining us tonight. Good to see you,
Bill.
Don.
Great to see you. Thanks, Sue.
Coming up, automakers are shifting gears.
New models, new plans. I'm Phil LeBeau at the Detroit Auto Show, where automakers are laying out their road to the future. That story coming up on Nightly Business Report.
Despite concerns the auto industry has too many plants and is building too many vehicles, at least 2 automakers say that they will build more assembly lines in the U.S. The announcements came today at the North American International Auto Show, and Phil LeBeau is in Detroit.
Make no mistake, the auto industry is in an arms race, with automakers investing in new models and new plants. Volkswagen took the wraps off its new Passat, then announced plans to hire 1,000 new workers to build a second plant in Chattanooga, Tennessee, where it will crank out electric models starting in 2022.
We want to grow here in the United States. We have good momentum with our new product. We have a very good team. We have been gaining market share. We think the electric cars will have a chance here in the U.S.
Cadillac is also plugging in, showing images of an all-new electric model that will go on sale in 2021. The move comes as the industry tries to catch up with the success of Tesla. Last year in the U.S., Tesla easily sold more electric cars than any other automaker. But GM says it is too soon to declare Tesla the winner in EVs.
I think we got to wait a while to write the whole story because we don't know what happens when EVs really start to scale from a distribution and a customer experience perspective. So, for the rest of it and a profitability perspective. So I think we got to wait a little while before we write the whole story.
But for all the focus on EVs, the models generating the biggest profits and the most sales are trucks and SUVs. And no brand is hotter right now than Jeep, which is why Fiat Chrysler is adding assembly lines to keep up with demand.
Well, one of the things we're going to do in our current 5-year plan is we're bringing 2 new white space products to Jeep. We're going to bring a 3-row variant in the full size, and in the large, we're going to bring back Grand Wagoneer. Those 2 vehicles are going to need new capacity because there's no way we can fit it into our existing manufacturing infrastructure. So we will bring capacity on board for those, and as you know, the pent-up interest really in Grand Wagoneer is huge. So, yep, that will have to happen in the very near future.
Expansion plans for an industry in transition. Phil LeBeau, Nightly Business Report, Detroit.
Well, not only is the auto industry in transition, but so is retail. A finicky consumer and new technology are just some of the issues facing that business, and they were addressed at the largest trade show of the year, hosted by the National Retail Federation. Courtney Reagan was there for us tonight in New York.
40,000 people from around the world in attendance, from retailers to software companies to startups and more, with 2 goals: to discuss the latest trends in retail, which change as fast as shopper tastes, and to showcase the newest retail technology to serve them.
Meet Millie, a Canadian fashion brand and German grocery store are experimenting with her to greet shoppers and answer questions. Hey Millie, how much are these sunglasses?
Normally a lot, but I like you. There are smart carts that scan groceries as you go, and technology that adds up your items as you shop so you can walk out without a cashier. And analytics that identify consumer gender, age, and more to micro-target for personalized messaging, while gathering data about shopping patterns to feed back to the retailer. Plus robots and drones to make filling orders, stocking shelves, and gathering inventory information easier. But as cutting edge as all the artificial intelligence and machine learning technology is, CEOs of the country's biggest retailers say traditional stores remain their biggest asset.
They function as service centers, fulfillment hubs, and they're incredible showrooms for inspiration. In fact, this season, our digital business outperformed the industry by over 50%. And that's largely because 3 out of every 4 digital orders was fulfilled by a store.
The stores are a wonderful asset for us, an asset from a customer standpoint, because a lot of the stuff we sell, you need to touch, feel, be able to ask questions, understand how everything is going to work together. They're an asset for the vendors because they get to showcase their products, and they're an asset from a supply chain standpoint. About 40% of the online orders are actually picked up in the stores, and that's growing.
So while virtual stylists, AI-powered robots, and cashierless technology enhance the retail experience, maximizing the utility of stores remains retail's top priority. For Nightly Business Report, I'm Courtney Reagan in New York City.
One more look at the day on Wall Street, a minor minus day, if that is such a thing. Down 86 points for the Dow. The NASDAQ was down 65, the S&P down 13.
And that will do it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. See you tomorrow.